So, April 17th, the stock market was just a sea of green, right? Looked like a huge win for investors. But, the final score, it almost never tells the whole story. What was really going on beneath the surface was this dramatic mood swing, from total fear to a new sense of confidence. And getting a handle on that is the key to understanding what really makes the market tick.
All right, first things first, let's look at the big headline number, because it was pretty impressive. The BSC Sensex, it shot up over 500 points, closed at 78,493. I mean, that's a solid 0.65% gain for the day. By any measure, that's a great result. And hey, it wasn't just the Sensex either. The Nifty 50 also had a really strong showing. It jumped 165 points to finish the day above that 24,350 mark. So yeah, on the surface, it looks like a pretty simple story, right? Just a good day. But what was the feeling in the market? I mean, how do you actually measure something like that? The collective anxiety or the confidence of thousands and thousands of investors. Is there like a number for that? Well, as it turns out, there actually is. Okay, so to solve this little mystery, we have to look at a very specific indicator. You might have heard it called the Market's Fear Index. Its official name, though, is the India VIX. So what is the India VIX? The easiest way to think about it is it's the market's mood ring. It actually uses options prices to figure out how much volatility, how many big price swings investors are expecting to see in the Nifty 50 over the next 30 days. And it pretty much breaks down into two simple states. If you see a high VIX, that means investors are getting anxious. They're expecting big swings. They're bracing for what you might call choppy waters. A low VIX, on the other hand, well, that signals confidence and stability. It's like investors are expecting smooth sailing ahead. Now, this is the really crucial point. The VIX is not a crystal ball. It doesn't tell you if the market's going to go up or down. Nope. It just tells you how intense, how bumpy the ride might be. Think of it more like a tension meter, not a signpost telling you which way to go. And this is the key to our whole story today. When you see that VIX number falling, it's a super clear signal that the collective fear in the market is dropping. It means investors are kind of breathing a sigh of relief, and that often creates a much more stable environment for growth. So what exactly happened on April 17th that made all this fear just fade away? Well, the answer really lies in the global headlines. Basically, three major things happened. First, there were some new signs of de-escalation over in the Middle East, and that really eased geopolitical tensions. Second, and this is a direct result of the first point, crude oil prices started to moderate. U.S. oil fell pretty significantly. And third, the Indian rupee actually got stronger against the U.S. dollar. Now, for a major oil importer like India, lower oil prices aren't just good news. They are a massive relief. It reduces the threat of inflation, it lowers costs for countless businesses. So when you put all these things together, it was like a collective sigh of relief washed over investors. And this brings us right to that direct link between how people feel and what prices do. Let's look at the numbers and see this cause and effect play out in real time. Okay, first up, the cause. The India VIX, our fear index, remember, it plummeted by nearly 5% during the day. It ended at a much calmer level of 17.205. You could just see the fear officially fading. And now, for the effect. As that fear went down, confidence went right up. The Nifty 50 rose by 165 points. That's a gain of over 0.5%. Boom. I mean, look at this table. It tells the whole story in just one snapshot. You've got the fear indicator, the VIX, dropping big time. And at the same time, the price indicators, the Nifty and the Sensex, they just climbed higher. It is a perfect inverse relationship playing out right before our eyes. So why does any of this matter to you? Well, understanding the VIX isn't just for the pro traders on Wall Street. It's actually a really valuable tool for anyone who's even a little bit interested in the markets. So here's the big question. Does knowing today's VIX level help us predict what's going to happen tomorrow? Well, not exactly in the way you might think. You have to remember, the VIX is not about predicting which way prices will go. It's a forward-looking measure of expected volatility. It gives you a feel for the market's emotional state and helps you get a handle on the potential risk level in the near future. And that is useful for absolutely everyone. Sure, day traders use it to gauge short-term moves, but long-term investors can use it to understand the broader market mood before they make a big decision. It gives you this incredibly valuable context that goes way beyond just looking at the price.
So the next time you see a big market headline, do me a favor, look for the India VIX. Because then you won't just know what happened to the price, you'll understand the story behind the numbers. So the real question is, now that you know this, how are you going to see the market differently?